Now, I want to start this video by saying one thing. Contrary to what you've probably heard online before, trading is far, far simpler than you could have ever imagined. Every trader that I've worked with has gone through the phase of learning different concepts and different strategies and different ways of thinking before ultimately reverting back, simplifying what they're looking at, diluting their knowledge, and then that's where they find profitability. All you need to become a consistently profitable trader is a simple mechanical strategy that has been proven to provide you with an edge over the market and the discipline to stick to it. That's it. So with that in mind, what I want to do in this video is cut out all of the BS. In front of me now, I've got my trading journal from last week, and I'm going to go through everything. I'm going to show you every single trade I took last week that resulted in me being able to make 13.26%, really trading for no more than an hour or so each of those days. So let's dive straight in. And first, let me show you my trading journal. Again, it's very, very, very simple. So as you can see here, this is just my Google Sheet trading journal. I keep things very, very simple when I journal my trades. I just like to have a log of my positions here, primarily, honestly, so I can go through them with some of my students. I don't really journal for my own benefit anymore, but I thought I'd show you inside of it for the purpose of this video. So as we can see here, we have got 6 positions. We have got 3 wins, 2 break-evens, and 1 loss. So what I'm going to do today is I'm going to go through every single one of these trades. We're going to break down every single one of them, and I'm going to show you the exact strategy that I'm using in order to pull in 13.26% in weekly profits on and using this strategy. Now, I will preface this, like, I'm not one of those guys that's going to say I'm making 13.26% every single week and I'm making that. It's not the case. Sometimes the strategy is going to give you 13.26%. Sometimes it's going to give you nothing. But that's the whole point of this video. You have a set of mechanical rules. If your rules are being met, you take the trade, and if they're not, then guess what? You sit there and you do nothing, right? You don't want to be caught in that enticement of the market, right? You don't want to lead yourself down that road of being a gambler. So let's cut this. Let's get on to the charts, and let me show you some of these positions. There we go. So right here then, so what have we got? So this is EURUSD. I mean, most of the trades from last week came from EURUSD, so we'll start here. So let's start on this one here. Very, very simple, right? And as you've probably seen in my last video, actually, we're talking about really understanding liquidity, and that's all my strategy is built on. It's about having a real deep understanding of liquidity with very clear mechanical rules to help me actually benefit from those moves that I can identify. So what have we got here? So a quick overview of this position. Number 1, ASR lows get taken. We sweep liquidity. We have a primary sweep of liquidity that aligns with those Asian session lows. Asian session lows on their own are not liquidity. Make sure you remember that. Structural liquidity is the most important part of liquidity. We have that initial primary run of liquidity, and then what happens, because the ASR lows have been taken and we're looking for buy trades, we always trade away from that run of liquidity. We know that therefore the Asian session highs become that targeted point. So how did I get into this position? Very, very simple. How do you know when the market is changing direction? Well, the market direction changes, right? The market structure changes. The characteristics of that downtrend start to give us characteristics of a bullish trend. So as we can see here, I've got marked out the change of character. So we look for the characteristics of that trend to change. As we can see here, we've got that nice shift in market structure. So it's now telling us, okay, it's now telling us that this this liquidity is now doing a sufficient job. Okay, it's confirming to us that this liquidity is strong enough to actually make a change in the market. So market structure has shifted. We then want to make sure we can identify that there has been significant volume coming into the market. We then have that retracement. We fill and take some of that lower time frame liquidity as well for additional fuel in this move. Get tagged into the entry below this inducement. Okay, this is where I've had my entry. This is where I had my entry set below this inducement, above this area of demand. We have our break even there on that first break of structure. And then again, we know that we're targeting what is essentially the ASR highs. Obviously this 1 minute candle is slightly off, but ASR highs were here. And we can see that this position was a 6.52 risk to reward. So really on this position, let me put this on mute, that's very annoying. Really on this position, we got into the trade at 9:20. So it's actually a much later trade, but again, everything here is done through alerts, not necessarily sitting here and watching things. So 8:40, we see that deeper run into liquidity there. We then have to change a character at 8:53, get tagged into the trade at 9:20, and then TP is here, I think about 11 o'clock. Yeah, so 11:11. So all we do here is we get our break even set. We let that trade run to that target. I don't really take partials. I'm usually in and out of the market in very, very small moves. If we're looking at sort of like pip value, very relatively small moves. A 6.52 risk to reward is actually on the higher end of the typical trades that I take. I think my average is around 3.8, but for me, I would rather prioritize my psychology and my ability to perform at a high level consistently, as opposed to taking partials, letting trades run to high risk to reward levels. I know where the market could potentially turn around. So for me, it's about getting into these positions super mechanically, and that involves the exit as well. So I know exactly where I'm going to get out of the positions. So that was Friday's trade, 6.52 risk to reward, really, really good position. And we actually had one on Thursday. Now, one thing that usually does happen, or one thing that I'm cautious of when it comes to my trading is overall expectancy. It's not super often that I see sort of back-to-back trades playing out throughout the day, throughout the week, sorry. So if I have a trade on Wednesday, typically won't see one on Thursday. However, I'm acting mechanically and not emotionally. So I'm not necessarily using my discretion to make my decisions. I'm literally just following these mechanical rules. So same thing applies here. We have got ASR lows have been taken. We have then swept this liquidity that is resting below the Asian session lows. It's not because of the Asian session lows. We've seen this internal bullish change of character, which again, not the strongest sort of reference of liquidity, but it does build liquidity there. So it's all about judging and identifying the intentions of these moves. Objectively, it is liquidity. We did sweep it and we did get confirmation. So again, we know here, sweep of liquidity, we get our confirmation. We know that if we are then looking for buy trades, because the ASR highs haven't been taken, we know that that's naturally then the target. So this position here was a 4.66 risk to reward. If we drop down, so this one I actually had two entries on this one. So we can see here the first one, we've got that sweep of liquidity here at about 21 minutes past 7 in the morning. So I always start from 7. We can see we've got that nice bullish chock again. We've got the imbalance in there to confirm that the volume is sufficient for this move to be valid. I took my entry here, and unfortunately on this one, we actually ended up just blasting straight through. So I took minus 1% initially on this move. But then what we did is we had a deeper dive into that liquidity. So if we think about what liquidity is, it is just orders at price levels. Okay, so occasionally we might not be able to get a sufficient volume into the market from that initial run. So we then go into deeper prices within that liquidity pool. We're then able to execute more orders into the market, which then in turn creates a better reaction, right? Sometimes this happens, sometimes it doesn't. Sometimes you need a few cracks of the whip to get into position, right? It's completely normal. So -1 on this one. We've then again seen new bearish structure being formed. We've then got that second shift in structure. We've got the imbalance in there. Market pulls back into the middle of this imbalance. Again, I usually go off the imbalance in most cases. We can then see we got tapped into the position. We got our break even after that first break of structure. And then again, we can see that this ran away quite nicely. Now, again, a lot of people are going to be looking at this and saying, oh, well, the market pulled back a ton and it was super risky. Listen, I know where the market is going to go after this. I know the probabilities of certain points being hit, right? An edge and a strategy is not just built on entry criteria. It's built on your stop loss criteria and it's built on your take profit criteria. That is how I have built my mechanical rules. This is not me just getting into trades. I know that when X happens at X point, the probability is we're going to go to Y point, right? We're going to go from point A to point B. I know that that is what my strategy does. So therefore, what do I have? Conviction in these moves. I don't need to worry that we've had a pullback because I know that the chances are we're going to go to these highs. I was already at break even, so my risk was off. Yes, I had a good chunk of profit running on this position already, But again, I know that this is normal price action, right? We've got all of this imbalance here. All we've done here is literally come back and tap into this demand here, right? There is no real reason for this to go any other direction. I know that when we have a primary run of liquidity, then that is typically going to mean, in this circumstance, the Asian session highs are going to be a targeted region. So again, I have conviction in that move. So 4.66 risk to reward on this position. And again, you'll notice these trades, yes, they come in all different shapes and sizes, but fundamentally they are the same, right? It's the same set of mechanical rules, time in, time out. I mean, I guess that is kind of with the exception of this one, right? This is a slight adjustment of my rules. I've kind of got two models that I trade, depending on where that primary run of liquidity comes from. So on this one, we can see that the Asian session highs get taken, but then the primary and that initial run of liquidity comes from a point at which indicates we're going to go away from the Asian session range. So therefore we're seeing a continuation setup as opposed to that reversal setup, right? We're following on this initial trend. So again, what have I done? Primary run of liquidity. Lower time frame confirmation to confirm that that run of liquidity is actually doing its job, right? We want to have confirmations. We want to understand those lower time frame 1 minute confirmations to understand whether the probability of this move playing out is actually there, right? I'm not just jumping into the trade blindly. I'm seeing confirmation. So again, what have we got? Deep dive into liquidity followed by a nice snappy reaction. That reaction from liquidity has then in turn created that lower time frame market structure shift. We have confirmed it because we have the imbalance in that move. I'm looking to enter as that pullback comes down because again, the market doesn't move in one direction. We push and we pull, we get that break even. And then unfortunately on this move here, we ended up pulling back and getting taken out of break even. So again, win, lose or draw. Our job is not to be emotional in the way that we trade. Our job is to be mechanical. If we're mechanical, we don't need to be emotional, right? It's about removing as much discretion as we possibly can. The number one reason that most traders fail, other than the fact that they usually use garbage strategies that don't provide them an edge and they're actually gambling, is their psychology. Even if they do have a good strategy, they can't stick to it because, I mean, usually it's not mechanical, right? It just becomes an absolute shit show, right? So everything I do is about being as mechanical as possible. Do I slip up? Yes. Does that affect my results? Sometimes, yes. Am I optimizing my trading to the highest possible point I can? Yes, I am. Right? I'm a human, but I'm trying to do as much as possible to remove as much of that human error, right? And all of the errors that I make, just from my journaling, just from my testing, just from my assessments of how I perform, they always come because I'm making decisions based on how I feel and not based on the rules that I'm trading with. So this one here was a break even, so 0% lost. And then finally here on Euro USD, we have this lovely position here. So very similar to the one that I was looking to trade the day after. And again, this is sort of expectancy. I kind of expected this trade not to do what I wanted it to because I had one the day before. But this was a really, really good opportunity, actually, a really nice position. And I mean, I really like these trades, this one in particular, where it's so intentional, right? It's so intentional. They can be a bit more difficult to spot unless you actually really understand what you're doing. But these trades where I'm in the trade at 7 o'clock and I'm out by 7:30, my day is done. That's kind of everything I've been trying to build over the last 10 years in the market, right? This is exactly how I wanted to trade when I started because I didn't want to have to sit here and stare at a chart all day. That's not what I wanted to do. But we'll break down this one anyway. So we can see here that Asian session highs have been taken just after that 5 o'clock mark. We have then actually run into a point of liquidity, which has then helped get us down into this primary area of liquidity, liquidity ready for the market to open at 7 o'clock. What has then happened at 7 o'clock? We have been within this pool of liquidity. We've had our confirmation and then we have had our expansion, right? We've had our primary run of liquidity. We've had that move that we can be looking to trade, right? I'm never, ever going to trade a run of liquidity before 7 a.m., right? I mean, the caveat to that is as long as I haven't had my entry before 7 a.m. because it's still then being utilized in the same way. But if, for example, we have a move like this, I'm not going to take it because there isn't that backing, there isn't that volume in the market to actually have the conviction this is going to do the same thing as we would be looking to see if it's like a 7 a.m. run of liquidity, right? There isn't that volume. The markets are shut, right? The markets are not open. People are not putting orders into the market. So therefore, it's not going to have that same snappiness that we're expecting. But as we can see here, is utilized to get the orders that we can in to get us down into this liquidity down here to create that expansion. Now again, this is liquidity because, I mean, it's liquidity in it's fractal liquidity, so it's fractal structure. So if we drop down to a lower time frame, we'd be able to identify that because this candle here has traded below the previous one and not above the previous one, all that shows is that we've had a pullback. So if I'm ever trading liquidity, I always have to make sure that it's present on the 15-minute time frame. I'm not trading 5 minute, 1 minute, anything like that. I'm only trading 15-minute liquidity. So again, we run into this pool of liquidity. We can see that this liquidity has created that bullish market structure shift as we're looking for in all of our trades. And then at 7 o'clock on the dot, we have pulled back to fill the imbalance and mitigate the area of demand that we created to the downside. So again, I'm not looking to do anything until 7. So I was just about able to catch this position. And then all I did here was, obviously we got our break even, and then I just ride this into that next week targeted 15-minute high, which is obviously this high just up here. So again, this position was a 3.08 risk to reward position. Again, same rules, same entry criteria. I mean, we kind of have it's one strategy basically, but it's kind of two different models depending on where that primary run of liquidity comes from. It's going to depend on how we trade this, but we always use the Asian session range as reference, right? That is always the key part as to what we do. I trade London session pretty much primarily. If I'm about, I'll catch a New York trade, but to be honest with you, I would rather watch paint dry than sit on the charts for the whole day and just watch things. I would rather just wake up, get my trading done, and then just leave and then just do something else with my life. Anybody that spends, I mean, I've seen so many traders just spend 10 hours a day on the charts, and then a year down the line, they're just either an absolute zombie or they've quit or they've lost a ton of money. So for me, trading was always to give me that level of freedom and income where I don't have to sit here and work all the time. I got into this because I didn't want to go and get a job. So I would rather just use trading as my sort of cash flowing tool, my skill set, and then just go and do other things that I enjoy. So yeah, really, really nice position. In and out of this one. I mean, how quickly was this? 7 o'clock entry, obviously, and then out of the position at 22 minutes past 7. So at 22 minutes, and I've made 3.08%. And with the level of account I'm trading with, it's a good amount of money. You don't need any more than this. I'm not really here to try and catch a 1 to 10 or a 1 to 8, 9 risk to reward. I don't care for that. I know the probabilities. The higher the risk to reward, the lower the chance of you hitting it is. I'd rather just get in, make my money, and leave by 22 minutes past 7 if I can. And again, I've tested this. I would rather just get in and out instead of having the anxiety of leaving a trade to run. I've already tested where my target should go on these positions. So I don't need to leave these trades to run too long. You see everyone glorifying these huge risk to reward trades, and yeah, when you hit one of them, it looks good, but yeah, you'll hit one of them every 6 weeks maybe, and then what about all the losses you take in between that? It just doesn't work. So I'd rather have a very clear, very simple set of rules that I follow day to day. If it's there, I take it, and if it's not, I'll sit on my hands and I'll wait, and that's all I really need to be doing. And then yeah, we got one final trade, which was I think a loss maybe. What are we looking at here? Oh yeah, this one. It was on the Monday. Was it a loss? No, it's a break even. So again, very similar. ASR highs get taken. We run into that first point of liquidity here at 7 o'clock. So very similar to all of the other positions. The anticipation here is that this primary run of liquidity is going to push us down into those ASR lows. As we can see, this trade is set up. And then obviously this one, we had the reaction, and then we've just turned around and run to the upside. Now, again, there could be a million different reasons as to why this happens. In all honesty, I don't care. I've factored in all of these positions. All I do is follow my process. As long as I follow my process, well, guess what happens at the end of that? I actually make money. That is including wins, it's including losses, and it's including break-even trades. So I try not to look at the reasons as to why a trade lost, because I've already done the hard work and actually back tested and proven a strategy works. So my job now is literally just to follow it and not worry about everything else that can potentially go on, right? The second you start to look for errors in your trades, once you've actually got a proven strategy, is the second you start to move the goalposts. It's the second that you start to include discretion in your decisions. And that's the one thing you don't want to be doing in trading. So Again, as you'll see here, exactly the same entry model. In fact, this entry model actually looked like pretty perfect. We've again seen that run of liquidity here, market structure shift, good imbalance, tapped in, break even, and then it just turned around. So unfortunately on this one, wasn't able to add any more profit to the score sheet. So would have been nice, 4.13 would have been a good position, but again, the job is to follow the process and not worry about the results because you've already proven that it works. So what have we got here then? Let me just cut back to, let me see if I can get back to my chart, not that one. There we go. So overall then we had 6 positions, 6.52 risk to reward, which is like really nice, a really, really good position. Usually we're around the like 3 to 4.5% positions. Win rate is usually around like 70% or so. So pretty typical week for the most part. I mean, the trade frequency here is pretty high, like, but again, you can kind of see what's happened. Like, so 17th win, 18th, another valid trade, but it ends up being a break even. 19th, I had a win, but I also had a loss in there as well. But again, it's still a winning day. And then 20th, also another win. So, I mean, it's kind of an anomaly, right? I will usually have wins will come like every other trading day. Like I'll very rarely have like back-to-back winning days. That usually doesn't happen that much. But again, you can kind of see here. So like the Monday break even, the Tuesday win, the Wednesday break even, the Thursday a loss first and then a win, and then obviously Friday we had another win there. So I mean, it's kind of chopped up a little bit, but yeah, overall really, really good week. I mean, probably like time spent on the markets is maybe a handful of hours. So yeah, pretty laid back trading. But like I was saying at the beginning of the video, trading is really not that difficult, right? I think a lot of the content online leads people to believe this is so much more difficult than it is. It is literally just, I mean, once you've built a strategy and you've built a process and you have proven that that process works, which it does take a bit of time, like you need to kind of have breakthroughs and realize these things and then actually put the time into testing these things over like many years worth of data. But once you've got that, your job is like literally just to follow that process, right? You have a set of mechanical rules, you tick, 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 place the trade. And if you can't tick all the boxes, you don't place the trade, you just sit and you wait. You don't need to have all of this complex analysis going on. Like, you don't see all of that crap on my charts because I've done it. I've been there, I've done it, it doesn't work. Or, I mean, if it does work, like you're very, very small percentage of people are making it work because it's purely discretionary based. So trading can be this simple. You just have to learn the right things. So I hope you've taken some stuff from this video. Any questions, just fire them in the comments below. There's a number of links. Listen, if you want to come and work with me, you want me to teach you these strategies, help you implement them, give you mentorship, all of that good stuff, there's links below. But I hope you've enjoyed this one, and I'll see you in the next one.